All right, let's get started. Good afternoon and welcome to our third Thursday webinar. I'm Amber Krier, Managing Director of Business Development at Sowell Management, and your host for today. We are very excited to have the team from IDX Digital Assets joining us to demystify Bitcoin and Ethereum. IDX is a quantitative asset manager with a focus on risk managed exposure to digital assets. We'll be speaking today with Ben McMillan. Ben is the founder and chief investment officer of IDX Digital Assets. Ben, welcome.
Hey, thanks for having me, Amber.
Absolutely, we're glad you're here. Ben, in our pre-event survey, we asked advisors about the biggest challenge to getting involved in the digital asset space, and the number one response, even above high volatility, was actually simply understanding and knowledge of the asset class. So let's kick off today's call by having you give us a high level state of the world, and then maybe we can get into the numerous questions that our advisors have for you today.
Perfect. So it's actually timely. I mean, Bitcoin has kind of come to the fore of a lot of advisors' minds, at least the ones that we've talked to. And I'm going to go through a couple of slides. I'm not just going to kind of labor away, but I did just give a talk about the volatility of the space, which I think is kind of an appropriate starting point. And that gets into, some of the structural reasons behind that volatility, and then, really what the technology is. It's no surprise, obviously, that, Bitcoin is a volatile asset class. When you look at a chart like this, since its inception, it's been really orders of magnitude more volatile than really any other asset class, with the, brief exception of oil and EM stocks. And, it's something that, is really kind of a stumbling block for a lot of people to even get their minds around, let alone starting to think about how to, responsibly include it in client portfolios and things like that. One of the things we always like to show too is, back to the old Warren Buffett definition of volatility, or risk rather, which is the likelihood of permanent capital impairment. When you look at some things like drawdown, Bitcoin is no stranger to, or digital assets in general, are no stranger to, really huge drawdowns. And so, to your point about kind of what is Bitcoin, or what are digital assets, it's really technology, and it's revolutionary technology. The best analogy we have is, the internet, kind of dot-com stocks from the mid to late 90s. And like that era, cryptocurrency or digital assets are demonstrating, very kind of bubble-like or speculative type behaviors. One chart I like to show is, NASDAQ versus Bitcoin with kind of overlapping time periods. And, again, don't read too much into this. The statistical inference when you've got, just line charts like this is always overemphasized. But the anecdote remains that this is, blockchain technology in general is really a transformative technology. And, like the internet stocks of the 90s, there's a lot of speculative excesses there. What's interesting too is, what we've seen more recently is a lot of quantitative easing going into the digital asset space. In this era of quote unquote TINA, there is no alternative. Everything, traditional asset classes are very richly bid. What we found most surprising is, a lot of the stimulus, a lot of the quantitative easing has kind of directly gone into, the digital asset space. And so, you've got, on top of it being, this kind of new technology that market participants are starting, to get their minds around how to value. You've got this exogenous factor of printed checks basically coming straight into the asset class. And that really adds a lot of volatility on top, technical volatility on top of, what's structurally there. These are just kind of funny headlines, but they're real. Again, you have a lot of the younger generation getting into this asset class before they even own stocks and bonds. Another thing too is the influence of China. China's a big player in this space. And, to your point about kind of the state of play as it is right now, one thing that's important to understand about, digital assets is a lot of the benefits, which we'll get into, but a lot of the benefits in terms of decentralization, immutability, have really appealed to countries like China, specifically Chinese nationals. Bitcoin, they were very early adopters. Bitcoin was a phenomenal way to bypass the currency controls of China. For that exact same reason, the Chinese central government has always hated Bitcoin. But they're a very big player in the space, much more so than in traditional asset classes. So, again, that's another kind of factor that needs to be taken into account when thinking about kind of the structural volatility of the space. And then kind of lastly is regulatory pressures. And, these are always the big things that we highlight for folks is, understand that this is a kind of a revolutionary technology, understand that you've got these macro backdrops like quantitative easing and players like China that are contributing to the volatility. And then on top of it, you've got a regulatory threat, which is kind of always looming out there. To date, crypto has largely remained fairly unregulated, and clearly that's not the case anymore. We're seeing it play out now in Congress. Central banks and specifically the U.S. is starting to understand or starting to think about, how to regulate digital assets. And so those are, those all combine to be, kind of a powerful ecosystem of, not necessarily risk factors, but factors that investors or advisors need to be aware of. Last chart I like to show is, back to price volatility. Bitcoin is often compared to gold, as a form of value, a hedge against inflation, macroeconomic uncertainty. And gold is not known for having, an especially low volatility profile, but I like this chart because it just shows you how much greater the vol of Bitcoin is. And again, the point to be made here is that, Bitcoin is an exceptionally volatile asset class, in the realm of what would be considered theoretical for many investors. And so that's always, when we start talking to investors about, approaching this asset class, in the context of how to work it into portfolios and things like that, we always really emphasize that the volatility is extremely high and has to be respected. And so, I'm going to go through these slides quickly. Like I said, we gave a pretty in-depth talk that goes into some mechanisms to control that volatility. But, the key thing is that, like any asset class, volatility is an asset class. Therefore, it has an expected source of return over time, a risk premium, so to speak. And it stands to reason that investors can systematically harvest that risk premium. This is from a Bridgewater paper, which I highly recommend, called Engineering Targeted Returns and Risks. But the takeaway here is simple. I mean, again, we're just looking at expected return of asset classes over time, which are a function of expected risk over time. And you can see as you kind of work your way from cash and cash-like instruments all the way up to the upper right, EM equities and private equity, this is the so-called efficient frontier. This is Finance 101. There's nothing new here. But it's important to, when we go back to that concept of risk, specifically with digital assets and Bitcoin. And what I'd like to call out too is this kind of crucial 50% threshold, which, below which the mathematic, the asymmetry of drawdowns really starts to compound against you. So the question is, well, what can investors do about that? So, we always encourage investors in the products that we build, the way we approach this asset class and have for years now, is to think about how can we turn that volatility into an asset, because volatility is an asset class. And we know fundamentally, volatility is a function of future uncertainty. And those uncertainties, those risks can be exchanged. Options are a perfect example of ways that counterparties can trade volatility. I go into an example of, Thales of Miletus, which was actually a good friend of Aristotle, invented the options market to take advantage of what he knew was going to be a huge olive harvest because of his knowledge of astronomy. And so he literally came up with the options to rent olive presses in the future. And, in the year 3 BC, he came up with a way to transfer risk between counterparties. And options have remained a phenomenal mechanism for risk transfer or risk control. The key of course is, all right, well, how do you use that? What is the price of an option? One thing that's somewhat unique, or actually fairly unique to digital assets and just extremely volatile asset classes in general, is that, the options are very expensive. So spoiler alert, for Bitcoin, unfortunately, you're going to have to really pay up for the options, irrespective of whether or not it's a put or a call. It doesn't matter what side of the risk you want to trade. you're going to have to pay up for the options. So here we're looking at, these are options from actually last week, and you're seeing implied volatilities of 100%. If we go back to that chart I showed at the beginning, we saw that, Bitcoin is a volatile asset class, to be sure, but if you look at that red line there, it's not as volatile as 100%, or at least very rarely. And so this is known as the lotto effect in behavioral finance. This is a fairly well-established kind of behavioral phenomenon. It actually explains the low volatility effect. People are willing to overpay for risky stocks or risky asset classes because of the potential for a payoff, which humans always overestimate. So the question is, and again, I don't want to get overly technical, these are just meant to be kind of intro slides, and we've got plenty of resources on our website and elsewhere that kind of go into the more technical aspects of this. But my point to be made that I want to drive home here is there is a way to, Bitcoin is an extremely volatile asset class. There is a way to harvest that volatility. The short answer is, you don't necessarily have to buy options. You can synthetically construct your own. Economist David Ricardo kind of summarized this adage 200 years ago when he said, cut your losses short and let your winners run. It should be mentioned too that he made a literal fortune following his own advice at the Battle of Waterloo. So this is, a well-documented risk premium in the form of trend following or momentum type strategies. AQR, this is another paper which I highly recommend, literally documents over a century's worth of evidence in favor of trend following or time series momentum across time periods, across geographies, and across asset classes. And so again, we go into, on our website, we have a very technical WebEx that spends, I think, close to 90 minutes detailing exactly how one can construct a robust way to harvest that volatility. But again, the short answer is we also have it priced, calculated daily by S&P. It's available on their website. And we encourage investors, there are products, we do manage money according to this index, but more importantly, we encourage people to think about it as a price discovery mechanism. Think about this as the synthetic basket of call options that you're rolling in this asset class that you're using to synthetically harvest this asset class, and then that'll give you a different return stream against which to compare things like a long-only allocation, or precious metals, or commodities, or even equities, or fixed income. And so again, we really emphasize this from a research perspective, and this is always the starting point when we talk to people about the digital asset space. Is let's just understand kind of the first principles, the structural first principles, of which volatility is the most important. And then how can we think about that volatility within a financial engineering context? How can we potentially use it? And at a minimum, how can we leverage, kind of quantitative finance coupled with this high vol asset class to think about other risk return profiles that we can use to benchmark, things like long only exposures, other digital assets markets, et cetera. So at any rate, like I said, I didn't want to go into a whole, 30-minute preamble there, but I think it is important to kind of set the context of the state of the world of Bitcoin today and how some of those influences are contributing to volatility, like quantitative easing, like global players. The fact that it is a revolutionary technology like the internet, and therefore it's going to take some years before people have an understanding of kind of what the appropriate way to value it is. But within the backdrop of all of that, there has to be a mindfulness of the volatility, the inherent volatility of the asset class for us as investors and fiduciaries before we even start to think about the exercise of what it might look like in a portfolio, et cetera.
Mm-hmm. Great, and talking about the volatility, I'm noticing on that chart you showed, oil was one of those asset classes that was creeping up there in competition with the volatility, right? We're talking about today's conversation. You're talking about the first new asset class since oil, right? 1800s. So a lot to be learned today. And your first slide is perfect to just jump in here. And to the participants, you do have the option to submit a question through the chat feature on the GoToWebinar. So that's just below that polls option that we talked about earlier. We also have two handouts to the Fiduciary's Guide to Bitcoin and blockchain, and then the fundamental token analysis that we have. But Ben, why don't we just start with the basics here on your slide? How help us understand this new asset class, and how are Bitcoin and Ethereum different?
Yeah, so Bitcoin, when the white paper hit in 2009, Bitcoin solved for a very interesting problem of how to basically be a digital form of money in a trustless way. So how can two parties that don't know each other send money back and forth without a trusted intermediary, which is what humans have relied on since the time of Mesopotamia. And so it's this, technically it's this so-called double spending problem, but really what it relies on is decentralizing the mechanism of that trusted intermediary. So if you think about a bank, if I were to send you a check or a wire transfer, something like that, it would go through my bank and then it would go to you. Well, if we take that banking mechanism and distribute it across nodes, or basically just computers, and if that operates as the consensus layer with some very clever math and programming, we can effectively decentralize that consensus mechanism. And so that really opens up kind of a whole range of options as it relates to digital money, which is really what Bitcoin was designed to be. Now, when Ethereum came onto the scene several years later, it was designed to be much more all-purpose, and that's the smart contracts. And so when you look at the ability now within the Ethereum blockchain, yes, it's distributed nodes, it's distributed computers, and yes, they're performing a consensus layer where they're looking at they're looking at various transactions, they're recording them to an immutable ledger, aka the blockchain. But also now there's this capability to build applications within the blockchain itself. So it's not just a single utility purpose, sending money back and forth or just sending Bitcoin back and forth. Now we can actually write code, put it on the blockchain, and it's entirely rules-based. So you think about the if-then, with Bitcoin, Alice can send money to Bob, and that's it. Bob can send it back to Alice. With Ethereum, now all of a sudden, we can build this logic where the code automatically deploys, it's transparent, everybody can see what the code is going to do, under what conditions it operates, and that opens up a whole new realm of possibility as it relates to applications. And so, what we've seen, I've got a slide in here which talks about, I'll come back to that because it's important. But when you think about, well, here, this is actually a good slide. So how does the smart contract work? Smart contract is created. Alice and Bob define terms of engagement for, let's say, money lending. All the contract terms are written as code. In this case, it's code that is deployed on the blockchain. So as opposed to, when you go to, Bank of America or something like that to borrow or lend money, that code is deployed on their servers. Sometimes it's on the Amazon cloud. Sometimes it's located remotely. That same application layer is now just deployed on the blockchain. That's the smart contract. So that is stored literally on the blockchain. And what's amazing about that is it can't be altered. So once it's deployed, it executes itself when certain events are triggered. So it could be, collateralization ratios for a loan. It could be when a price of a certain asset hits a certain, level. It could even be weather. Believe it or not, there's smart contracts out there that will trigger insurance payouts between two counterparties based on things like the weather. And so this has led to an explosion in the ecosystem of what you might have heard, DeFi or decentralized finance, where there's all kinds of apps across, traditional finance, real estate, insurance, supply chain, and logistics that are all powered by the blockchain. And so, therefore, the reason that's important is that you're removing a lot of the risk around, single counterparties. Now you no longer have to worry about, things like, internet uptime. You don't have to worry about bad actors behind the scenes. One of the things about smart contracts being deployed is you can literally see, you can look at the code, and we've done this. Before we trade coins on a decentralized exchange, as an example, we'll go and we'll look at the code of the protocol, the smart contract protocol, and just say, and really understand that we're comfortable that there's no vulnerabilities. what the pricing, what the terms of engagement are. And then nobody can change that. You know, anybody that's come from the hedge fund landscape will give you stories about 2008 when prime brokers would jack up margin rates overnight. For those of us that are old enough to remember, you know, 2005, you know, in the convertible bond arbitrage space, you know, prime brokers would double margin requirements literally overnight and put folks out of business, you know, just because they unilaterally had the power to define the terms as they saw fit, when they saw fit. All of that now is forced to be codified in smart contracts. So anyway, I don't want to, you know, ramble on, but because I could talk for another 60 minutes about it. But the point to be made is that that was a huge step in terms of innovation for Ethereum, because building out the smart contract capability now really opens up the realm of possibility for what can be powered on the blockchain as opposed to within, you know, more traditional centralized server environments.
Sure. So when we were initially talking about in that first slide, the differences between Bitcoin and Ethereum, you know, you brought up the removal of that third-party authentication process. So, which brings about, I think, the next buzzword is security. So, security being obviously a huge point of interest when it comes to, I guess, the Wild West of cryptocurrency and digital assets. So, the question lies is, can Bitcoin or Ethereum be hacked?
So this is probably not so much anymore, but a couple of years ago when we actually started managing money for advisors in the space, this was probably the biggest question we faced. I actually think it's the next slide. So the question is, all right, well, how can we be hacked? And there were a couple of high profile hacks early on, which spooked a lot of people, and they can really be kind of bucketed into one of three areas. So the first is just general phishing. And this can happen to anybody. This happens to, you know, e-commerce websites. This happens to Wikipedia, and phishing is a little bit of a narrow term, but this is just general, you know, kind of centralized hacks. And so when you hear about the exchanges being hacked, you know, that's, you know, hackers gaining access to, gaining access to passwords and things like that, and then they can go log into the exchange and take people's coins. Exchanges have since segregated private keys. That gets into the next vulnerability. So phishing is just like any other cryptocurrency scam. This is still popular. This is people emailing you or texting you and saying, hey, you won $1 million in the Bitcoin lotto. You know, click here, enter your private key, and we'll send you the coins. And then the question is, all right, well, what is the private key? One of the defining characteristics, and this is the biggest vulnerability within crypto, is it's what's known as a self-custodied environment. So you are your own custodian. So when I have a Bitcoin wallet and I pay somebody for a Bitcoin, it resides in my wallet, which is literally just you know, a digital cryptographic way to access the ledger and determine that I in fact own this Bitcoin. So everybody can see, it's, you know, remember, it's all transparent. So everybody can see my Bitcoin address. And in fact, a lot of folks like ourselves spend a lot of time and money deploying nodes that are pinging the Bitcoin network all day, every day, to look at addresses and see how many Bitcoins they have, how many they're trading, who are they trading with, to understand the velocity of the network. So you can think of the Bitcoin address as like your email address, except in this case, everybody can not only see your email address, so they can send you emails, but they can also see when the last time it was you opened an email, how many emails you have that are read, how many that are unread. They can't see the content of the emails, but they can see all the meta information. It's actually for quants like ourselves, it's one of the big appeals of blockchain technology in general, is that there's a very high level of transparency and therefore discovery, price discovery, as well as just information discovery. But the key is, just like an email, you have a password. That's the private key. And so if you give up the private key, and this is, you know, before people understood how important this was, this happened a lot, or you could just lose private keys. If you lose your private key or you give up your private key, you no longer have access to your wallet, or whoever may have tricked you into gaining access to your private key, that's all they need to get access to your wallet. So there's no two-factor authentication, there's no multi-sig capability. You know, like a normal custodian, you know, if somebody tries to use my credit card in Vegas, you know, Bank of America is going to call me and say, hey, is this you? nobody has your back in the crypto world, at least traditionally. Now as professional money managers have emerged, centralized exchanges like Coinbase do have multi-sig and two-factor. They are serving as the custodian. In fact, they are a regulated custodian. And so, groups like us will interface with Coinbase because there's an added layer of security there. But that's always been one of the big drawbacks to crypto, is that if you're going to do it alone, which you had to in the early days, you don't have to anymore. It's one of the big appeals of where the industry has come. But in the early days, if you wanted to buy crypto, I mean, when I bought my first Bitcoin in 2011 for $7 or whatever it was, it was hard. There weren't even cool wallets out there. I mean, you literally just had to download the blockchain. You had to write code to send from here to there, and it was tough. And I have old computers where I've got random private keys that I'll bring up, just because, they're difficult to store. And so that's one of the biggest, I think, distinguishing factors of blockchain technology, is you really have to be mindful early on. You can't take for granted that, like traditional asset classes, you can just set up a prime brokerage account or set up a Schwab account and start trading, where they act as the trader and the custodian. You really need to be mindful of, okay, where am I going to hold my Bitcoin? Who's going to hold it for me? How are they securing it? Is it a cold wallet? Is it a hot wallet? So that's probably the biggest risk vector. So just to reemphasize, phishing is just like any other scam on the internet. It just happens to be more prevalent in Bitcoin. At least it was historically, less so nowadays. Private keys is unique to blockchain and Bitcoin. That's something that, those are the keys to the kingdom, so to speak. That's what allows you to be your own custodian. The 51% hack is more theoretical, and all that means is, because it's decentralized, the banking system or the intermediary function is decentralized across this global network of computers. Theoretically, if one entity could control 51% of those computers, they could then control the blockchain. That's one of the reasons that decentralization is so important to, this is Metcalfe's law. This is so important to the blockchain, was, because if there's not enough decentralization, it's, the 51% hack becomes very easy. This is also one of the reasons, by the way, that China's been in the news recently, is because up until, fairly recently, 60% of the Bitcoin mining power, which is the computing power, actually resided in China. Now, it was a bunch of different companies. It wasn't all one actor, but, it did always represent kind of this theoretical risk vector, which we ourselves were very vocal about, that, if the central government, if the CCP wanted to surreptitiously nationalize these miners, they could have theoretically launched a 51% attack. Fortunately, for reasons that are kind of still unbeknown to me, China declared mining to be illegal, and all those miners were forced offshore, most of which were forced into America. So that was a huge benefit for us, and it was a huge benefit for Bitcoin as an ecosystem, because now this theoretical 51% risk became much more remote and much more decentralized. So anyway, back to your point, these are really kind of the, can Bitcoin be hacked? The answer is theoretically yes, through the 51% hack, but more often the hacks that people have heard about hasn't been the blockchain technology itself, because that hasn't happened yet, the 51% hack. It's been hackers getting access to private keys, or using just more traditional phishing attempts to get people's private keys, get access to people's computers or emails and things like that. So Bitcoin as a blockchain, or blockchain technology, is secure, but it is a function of the decentralization, which is why you'll hear a lot of folks like ourselves, really drill into how many nodes are there, how decentralized are they, and then also who's the custodian. If you're going to invest in the space and you're not going to, manage your private keys, who's going to do it for you?
Mm-hmm. Sure, that makes sense. So talking about decentralization, let's talk about central banks issuing their own digital currencies, or CBDCs. Can Bitcoin and those CBDCs coexist?
Yeah, so absolutely, and I think And I think what we're seeing too is there's been a big push by central banks to get into the crypto game. And, there's kind of an obvious reason for that. You know, to, Bitcoin and digital assets in general are just, forms of digital money. And so it makes sense that central banks would want to extend the technological capabilities of what they're already doing. Most of the fiat, most of the money that we deal with is what's known as M2, which is digital money in our bank accounts. It's ones and zeros that we send to each other through ACH and wire transfers. The actual physical currency in the form of linen notes or coins is much lower. So it is, if we take the technological progression just one more level, blockchain is a perfect utility for central banks, centralized actors, to broaden their reach. So the question becomes then is, the criticism has always been, well, one of the appeals of Bitcoin and digital assets in general is that they can't be inflated away. Bitcoin's a perfect example. There's only ever 21 million Bitcoin. Nobody can change that. The code is immutable. With Ethereum, there is an inflation rate in there, but again, it's codified. Nobody can go in and unilaterally decide, hey, I'm going to print 1 million Ether. They are released into the ecosystem at a predefined rate. And so, the knock always has been, well, central government can print as much money as it likes. And in fact, we've seen that to, an unprecedented degree in the last, 12 to 18 months. I think it was Howard Marks that remarked in one of his memos that 30% of all U.S. dollars in existence have been printed since 2020. And so the concern is always that, well, if central bank CBDCs aren't decentralized, central bank can just create as many as they want at will. Yes, of course, that's always the the criticism, but it can also effectuate a lot of efficiencies. Bitcoin remains, or digital assets remains, some of the most efficient and low-cost ways to send large sums of money between counterparties. Wire transfers is a really antiquated technology from the 70s. I mean, literally. God forbid you have to send one internationally. I actually did just have to send a wire transfer internationally, and the only way I couldn't even do it online at Bank of America. I had to go into a branch and sit there for an hour on Tuesday to get it done. And meanwhile, to do that over a blockchain network, even with somebody that I don't know, takes a matter of minutes. So there is a lot of technology there that I think central banks can leverage. And people will just have to understand that within the ecosystem of digital assets, there are going to be centralized or semi-centralized digital assets like CBDCs that are going to have different risks, like seigniorage or the ability to print at will. But we're seeing, I mean, it's an arms race. China's already way ahead. I mean, China, for obvious reasons, again, they've always had very strict capital controls, and they've always used their capital controls very aggressively in their population. They were the first to really go to market with a digital currency. And in fact, that was one of the big reasons that they made Bitcoin mining illegal in the country, was that they wanted to force an adoption of the e-yuan. And in fact, the rumor is that they wanted they have a certain level of penetration before the Winter Olympics in Beijing next year. So China already has a central currency that's out there. Adoption, from what we understand, has been somewhat slow, not surprisingly. The trust factor there, as I just said, is probably extremely low between the population and the government, but they're forcing it. The Bahamas already has one. That was more of a marketing exercise, and they just copied a bunch of code, but they have one. And our own Federal Reserve went from kind of academically exploring the idea with MIT a couple of years ago, or not even a couple of years ago, to very vocally and very actively throwing time, dollars, and resources to bring something to market. And depending on who you talk to, or depending on who we've talked to, that could be as soon as a matter of weeks, or maybe 6 months at the latest. But it's coming. So, to answer your question, I mean, I think central bank digital currencies have a place. We think they're going to sit within the ecosystem of digital currencies, and ultimately, we think it's going to be a very powerful on-ramp, as they say, for getting people into the crypto space. Once the central bank has a stable coin or something that's pegged to the dollar that can sit inside a wallet, that eliminates a huge step, both practically speaking as well as theoretically speaking, for people to start engaging in the crypto ecosystem.
Mm-hmm. So we've talked a little bit, and we have a couple of questions coming in, and I want to make sure we get to all of them. And specifically, I want to talk about one of the main things that our survey results came back with, which was, the digital assets fitting into asset allocation. But before we get there, obviously, there's a challenge in evaluating Bitcoin, and that it's truly innovative here. It's new. So outside of currency, what other positive attributes does Bitcoin hold relative to a traditional store of value like gold?
Well, I think there's a couple. Let's see. I think I'll come back to this. Well, actually, this is a good slide. So Bitcoin as a currency. One thing that we've seen that's really ramped up when we look at the timeline is a couple of big players adopting it in the form of everyday payments. So when you see MasterCard, Square, and PayPal and Venmo actually starting to introduce, Bitcoin as a currency, that's important because it's not just among hobbyists, like me and other people that have been doing it for years, but now it becomes an easy way for people to just transact value back and forth, just like they would across PayPal or Venmo. One of the other, I think there's a slide back here that talks about some of the other. This is a good slide that I'll come back to. This is a good one. Benefits of Bitcoin. Things like Bitcoin isn't technically anonymous, but it is good for KYC and AML purposes, because it's immutable. It's on the blockchain. There's a decentralized ledger where people can see where Bitcoins have gone and come from. And in fact, in some of the early exchange hacks, you can follow them on Twitter. There's these forensic blockchain analysts that will look at where the stolen Bitcoin have gone, what wallet it resides in. And there's even been, coordinated efforts to lock down those wallets, to the degree that, centralized actors can identify where they reside or what exchanges they reside and things like that. In fact, there was a recent hack of, $600 million on a blockchain that was actually a smart contract vulnerability. And so that's one of the things with smart contracts that I want to point on. The code is transparent, so you can look and read the code. But in many cases, these newer protocols or these newer blockchains, you're talking about millions of lines of code. And so there all are vulnerabilities there. And the hacker in this case took advantage of what's known as a migrator code vulnerability, which, by the way, we've seen in other blockchains that in some cases are actually those coins are represented in at least one DeFi index that's on the market as we speak. But it shows you the importance of back to my point about being a self-custodian, but to the extent that you're gonna, start investing in things other than Bitcoin and Ethereum, you're gonna have to get comfortable looking at their smart contracts and looking at the code and understanding if there's a backdoor that was maybe not deliberately, but in some cases inadvertently put in there. And so, there's been a lot of those. Technically, they're not hacks, they're just exploitations of vulnerabilities. But within the newer blockchains and the newer protocols, that's probably the biggest risk factor. But anyway, back to the benefits of Bitcoin, this is really kind of poorly termed. It shouldn't be anonymity and identity theft. It should really be more KYC and AML. That's a huge benefit. Store of value, low processing fees. Again, when you go back to the example of wire transfers, if you look at the market for wire transfers and international, SWIFT transactions, it's, people think that there's never lost payments, there's never errors. It happens all the time to a shocking degree. I mean, it's happened to me. If you look at the numbers there, the slippage rate from wire transfers, is way higher than it's been on the Bitcoin network. Security and control is another one. Again, you have to be mindful of the self-custodied environment, the private keys, but there you don't have to worry about a lot of risk vectors that kind of traditional stores of value have. I remember in 2008 talking to a Swiss gentleman at a family office who was complaining about all the security around transporting gold bullion from a vault they had in New York City to Switzerland. You know, this is one of the reasons when you look at things like China, you know, or Venezuela has been another good example, you know, transferring money offshore becomes a lot easier when it's digital. Now, of course, you know, the question regulars always bring up is that also, you know, theoretically opens up the door to illicit, you know, illegal activities. But again, don't forget, it's, you know, there's a lot of transparency here too. So it's difficult to transact on Bitcoin at least these days, it's difficult to transact on any kind of blockchain in an illegal fashion and expect not to get caught. It's relatively routine now to be able to pin down if there's bad actors, you know, you can see who they are, which is why a lot of these hackers that are able to extract money, the only way they can get that money into usable fiat is they've got to be essentially state-sponsored hackers, typically in Russia, Eastern Europe, China. So anyway, back to your point, you know, Bitcoin isn't, aside from just being a digital mechanism of payment and a store of value, there's a lot of these other attributes, including smart contracts, if we want to broaden the digital assets definition, which, you know, really you can think of it less as a payment system and more as an internet backbone or an internet replacement.
Perfect. So speaking of benefits, so I think our attendees that took advantage of the pre-event survey, 70% of those said that they would entertain using digital assets for clients for the reasons of portfolio diversification. So maybe you can talk a little bit about how and where you see digital assets fitting into asset allocations and client portfolios.
So this is really the $1 million question. This is where we've spent most of our time, as a fiduciary is thinking about prudent ways to do that. And so, back to the point, I've showed this slide already, but the volatility is real. And, I want to emphasize this though, the math of the 50% drawdowns in most other asset classes is largely theoretical. With Bitcoin, it's common. And you can just kind of intuit how much time is spent below that magic 50% drawdown. Well, the reason 50% drawdowns are so bad is, as we know, as the drawdown increases, the gain required to get back to break even goes up proportionally more. So when you get to a 50% drawdown, you have to double your money just to get back to break even. And then if you're down much more than that, if you're down 90%, which by the way, as we saw, Bitcoin has been, you've got to make multiples back on your capital. So for people, again, that have been in the digital asset space as long as we have, we remember the 3-year drawdown from the peak in 2017. And if it's easy to look back in retrospect and say, yeah, but it's up a zillion %. And if I'd only had 3% in a 60-40 portfolio, I would have made all this money. We saw it real time, practically speaking. When there's that much volatility and the drawdown is that big, people are selling at the wrong time, they're buying at the top. That's, again, there's literally Nobel Prizes that have been won describing the behavioral phenomenon of fear and greed and why humans are bad at making discretionary decisions in these types of contexts. But again, when the drawdowns and the risk gets that big and that often, it's a different game. And again, it's one that, when you look at this bottom part of the matrix, this is largely theoretical for most asset classes, even gold, even commodities. So it's something too that, is a really sobering reminder when people, come to us and they're interested in investing in digital assets. We're always reminding them that, you've really got to be mindful of this risk. And so again, kind of back to this exercise of, all right, is there a way that we can seek to mitigate this risk in a way that, still has asymmetric participation in the asset class? We encourage people to, again, this is on S&P's website. So you can go straight to their website, download this time series and understand what that might look like. But the short answer is, if you can avoid, if you're even relatively good at avoiding the drawdowns in a rules-based systematic way, then the capital can compound so much more efficiently to the upside. So you don't have to really stick your neck out trying to, capture all the upside, because you're not spending all your time kind of digging out of the hole, so to speak. And more importantly, it brings the volatility, or can bring the volatility profile down to something that's much more reasonable. Again, when you're talking about 70%, 80% drawdowns, in retrospect, when you're looking at a line chart at a point in time, it's easy to say, oh, yeah, but I would have just held, and this adds so much value over time. In practice, if you can get what we've found when we talk to mainly more institutional type investors is if you can get that volatility profile into something that's more analogous, that's just more, more reasonable, like commodities or like precious metals or like emerging market equities, then it becomes a lot easier to think about it realistically within a portfolio, within an asset allocation model. Otherwise, for lack of a better term, you're really just kind of inserting, a lotto ticket as a 1% or 2% slice and hoping for the best. Mm-hmm. I like to always show this chart. Ultimately, what you're doing, this is the synthetic call option that I spoke about. We can't go out and buy call options on Bitcoin because they're just simply too expensive. But if we can manufacture them in such a way, through a systematic rules-based process, then we have access to that. So what does that look like? And again, we do this all day, every day. We encourage people to do this for themselves. This is an analysis we actually just did for a group a while back. Let's look at a 60/40 portfolio. And in this case, let's look at that risk managed allocation. If you go back and remember, the drawdown was about exactly half what the long only was. So what we're doing here is we're taking a 60 portfolio and we're contributing equal risk budget to the risk managed Bitcoin index versus Bitcoin market price. That's just a long only allocation. So the risk managed index has roughly half the risk, so we can afford to contribute twice as much capital to it. And so if you've got a 6% versus a 3% within the context of a 60/40 portfolio, what does that look like over time? And so what we see here is, again, this is 60/40 with the 6% risk managed Bitcoin index. I do want to remind people this is an index, so it's gross of transaction fees and slippage and things like that. In practice, we've actually been running this for a couple of years now, and it's it's very reasonable. This trades on average about 8 times a year, so it's not extremely high it's not extremely high frequency. It is high turnover, but it's not getting in and out, every week or even every month for that matter. But what it is doing or seeking to do is, really just get step out of the way for those big drawdowns. And what you see is that, again, if you can do that even remotely well, despite the fact that you've got twice as much allocation to this kind of risk managed approach relative to the long only, your max drawdown within the context of a 60/40 portfolio, is still quite a bit lower. You've got better asymmetry. Your worst year is about on par. Similar vol profile and meaningfully more upside risk capture. And so, this also a little bit lower market correlation. And so, again, this is not, this is an instructive exercise for people to think about, all right, where on the risk spectrum, do I want my clients to be? How can I think about this within a portfolio responsibly? And what we found is, at least for a lot of the advisors we work with or the institutions, the institutions typically are they have a different type of asset allocation framework. You're dealing with an IC committee and things like that. With advisors, it's really the advisors who are communicating to clients. And so what we've observed, kind of somewhat to our surprise, is that by being able to truncate by being able to truncate this drawdown, and even most recently, we've really seen it this year where our models went flat. I think when Bitcoin was around $55,000, and a lot of people that had long only allocations, in many cases, people will have their crypto allocation will be split between a long only allocation and our risk managed approach. And they're freaking out, or their clients are freaking out because is it going to go to zero? What's going to happen? And from just the expectations management perspective, the client management perspective, having a risk managed approach that's rules based. We have a paper up on SSRN. It's also on our website that literally goes into the exact rules we use to construct this. There's no secret there. In fact, we like to tell people, listen, if you have the time and inclination, you can engineer this yourselves. You don't even need us. But the point is that it's rules based. but it gets the volatility profile into something that's just more manageable. You know, all of a sudden it starts to look like, you know, something that can sit within a 60/40 portfolio, and it's not overwhelming the advisor with, you know, phone calls about, you know, is this thing going to go to zero? So anyway, this, like I said, this is a useful exercise that we go through, even if people have no intention of investing in Bitcoin, but they just want to understand kind of the state of play as it relates to, you know, options for investing. You know, we're firm believers. We've always been very clear that we're not evangelists of digital assets. We think it makes sense for a lot of people, but you know, we are not like some of the groups out there that think everybody should have every 60/40 portfolio should have a 5% allocation or even a 1% allocation. There's a lot of portfolios that shouldn't have this at all. But where we do have strong conviction as researchers, really, first and foremost, but also as investment advisors and fiduciaries, is that if you are going to entertain digital assets, then you should absolutely, at a minimum, think about a risk-managed approach, because you have a lot of raw volatility, which you can use to your advantage, as we can see. So anyway, that's a long-winded answer, but I think it is an important exercise to kind of go through, you know, these stress scenarios and just understand, you know, what it looks like within the context of a portfolio.
So Ben, we're coming up on the end of our time here for the webinar, but I do want to just, if you don't mind, just briefly addressing, and then we'll kind of wrap things up. But I would say that advisors are still struggling with engaging in this space, and most of them are not allocating to Bitcoin to accounts. So what are the investment options that fiduciaries have if they decide to allocate to the digital space? If you can just kind of briefly give us a little bit on that.
Yep, and so this is a very good question. So, you know, traditionally it's been just kind of Bitcoin directly, and that would mean you'd have to open up an account at Coinbase. They would be the custodian on record. It would sit outside the traditional, custodians. Grayscale launched trusts a couple of years ago, which all the trusts did was they would buy Bitcoin. And those have to date, those have been, it seems, the preferred vehicle for many advisors. There are issues with those trusts. Historically, they've traded at a huge premium because they were easy to access. More recently, they've traded at a huge discount as others have come to market. So there is some basis risk there, which has been non-trivial at points. And you've got futures. You've got NASDAQ futures now, which is, again, more the realm of, I think, the hedge funds. I don't think we know of any advisors really using the futures markets. So those are the three big options. You know, we've got trusts. We actually launched our risk managed version for both Bitcoin and Ethereum in trust format. So those are private placements. After 12 months, you elect to have them traded on the OTC, just like Grayscale does. We're actually launching a DeFi trust. And so, you know, those are really the options for right now. You know, there's obviously a lot of talk about a Bitcoin ETF. You know, that may or may not happen. You know, I think a lot of people are overestimating how quickly that'll come. Again, depending on who you talk to and depending on who we talk to, the regulators seem to be taking a much bigger focus on the exchanges and kind of the activity around there. But yeah, those are really the options: is Bitcoin directly through, you know, generally like a Coinbase or even a Robinhood, Bitcoin Trust, which is what we see most advisors using because it can more easily kind of sit alongside other traditional asset classes, or Bitcoin futures, which again is more of a hedge fund type vehicle.
Perfect. Thank you so much, Ben. We really appreciate your time today and the expertise that you're able to lend us. I think we made some good headway in educating our group here on the space. And so for our attendees, our contact detail will be right here. If you submitted a question during today's webinar that wasn't addressed, we'll make sure and get you a response here in the next few business days. Additionally, you'll be receiving an email with a link to replay the webcast, and there will be a brief survey on there regarding today's event and then some future potential topics for future webinars. Actually, on that note, Ben will be joining us again next month on the 16th for a conversation on DeFi. So Ben McMillan of IDX, thank you so much for joining us today. Great insights. We appreciate you breaking this down into layman's terms. I expect that you'll be hearing from some of our attendees here, and we look forward to speaking with you again in September.
Absolutely. Thanks again.
Awesome. Great. Thank you, everyone, for joining us today. We certainly hope you found this useful and informative. Thank you, and have a wonderful afternoon.